McDonald's is currently trading at $294.78, which is basically the same price at which they were trading a year ago. And over the past 5 years, they are up by only 47.33%. So if we compare them to the S&P 500 over the past 5 years, we can see that they have severely underperformed the market. But what we have to understand is that this doesn't mean that they will keep underperforming the market in the years to come. So moving to our stock screener and jumping straight to the 9-pillar analysis, let's have a look at the profits growth of McDonald's. We can see that their revenue has been growing at a rate of 4.5% yearly over the past 5 years on average. They have been increasing their free cash flow at a rate of 11% yearly, and their net income has been growing at a very high rate of 14.24% yearly. So McDonald's is showcasing some very decent growth. Another thing I really like about McDonald's is their high 5-year profit margin, which is sitting above the sector median, sitting at 54.27%. And if we zoom into the 5-year profit margin, we can see that McDonald's has actually been increasing it very steadily over the past 5 years, and it is currently sitting higher than what it was sitting on average over the past 5 years. And the higher the profit margin, the higher the net income. Something I also like is that McDonald's has been decreasing their shares outstanding at a rate of about 1% yearly, and that they have a consecutive dividend growth sitting at 7.16% yearly. Now, one thing I don't like about McDonald's, if we zoom into the dividends, is their high 5-year free cash flow payout ratio sitting at almost 70%, which means that after paying out their dividends, they only have about 30% of their free cash flow left to direct into innovation, share buybacks, paying down debt, and raising that dividend. And this scares me even more when we have a look at the 9th pillar, the long-term liabilities over the 5-year free cash flow negative dividends, which tells us whether a company generates enough free cash flow to cover all their long-term liabilities. And we can see that this ratio for McDonald's is sitting at 5.30, which is higher than in the range we would like it to be in, meaning that McDonald's would take about 27 years to pay down all their long-term liabilities while paying out their current dividend. And with their high free cash flow payout ratio, I really don't like the amount of debt they are currently sitting on. Now let's also have a look at their 5-year PE ratio sitting at 28.58 on average, while we would like it to be anywhere below 22.5. Now what we have to understand is that McDonald's is a well-established company, and therefore investors are willing to pay a premium for it, and that's why it has been trading at a higher PE ratio than any other average company. And this is the same case with the price to free cash flow, also sitting at about 28.30. Now with the amount of debt they currently have, I personally wouldn't be willing to pay this much of a premium for the company. But the good news is that they have successfully been pushing their PE ratio down over the past 5 years, and it is currently sitting at only 25.88, which is lower than the 5-year average. So overall, McDonald's is trading a little too expensive for my taste, and they also have quite a lot of debt, but they also have very decent growth, which is the main thing that the stock price growth is reflected of. But now let's calculate the company's intrinsic value, first using the Grams formula. And here we will get an intrinsic value of $164.97 after plugging in a 5-year earnings growth estimate of 8.10%. For the second valuation model, we will plug in the free cash flow and plug in a calculated growth rate of 7.3% and get an intrinsic value of $316.10. Now for the third valuation model, we will compare McDonald's to 2 of its competitors and get an intrinsic value of $318.58. And finally, looking at the dividend discount model, we will project a dividend growth of 6.83%, but due to the mathematics within the dividend discount model, when the dividend growth is higher than the discount rate, the intrinsic value comes out negative, and therefore we will use our alternative model, which will give us an intrinsic value of $307.46. So finally, moving to the ultimate valuation, we will average out the 4 valuation models and get an intrinsic value of $276.78, which is actually 6% lower than the current trading price, and with a margin of safety of 15%, we would get an acceptable buy price at $235.26. So McDonald's would currently be a hold. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.